Hello, everybody. Welcome to Friday. Another really good day today. We're not doing our show, so I thought I'd just do the summary here. Let's kind of summarize the week, and actually, I'll summarize last month because it was worth talking about. So today, what was really important was that we were up 0.6% on the S&P 500, which we closed at a new high for the year. I think that's kind of important. We hit a high back on the 31st of July. And if you kind of just get right up to that high and then fail and come back down, you really kind of created what's called a double top. You could be establishing a new range where you come back down, or maybe even establishing a new downturn. So it's nice to see that we hit a new high for the year. Would be confirmation would be a couple more days above that high that we had back in July. That would make things, really kind of put in place. And so just a phenomenal time frame. The power of this market is really, really impressive. Actually, it just continues to push forward. We had Chairman Powell today doing a speech, and with the Federal Reserve, and he is, probably a little bit worried about how much the stock market has come down up and how much the bond market, yields have come down, both of which create more liquidity theoretically for the economy, which could try to reignite inflation. But inflation's going in the right direction. Job market's going in the right direction. Things are happening as they would like. There's very low probability, at least according to the market, that they're actually going to raise rates again at all, and might be lowering rates by next May or so. We'll see how that plays out. But in today's speech, he was trying to talk about higher for longer, and the market pretty much ignored it and went on its way. And going back in November of 2021 when this all started, boy, if he'd have said something like that, we'd have seen a big downturn. But you can only use that rhetoric for so long before people start to really look past that. And we're looking at, an inflationary situation that's getting better. So this week has been really fascinating. A couple of things that have happened. Number one, at the beginning of the month, we had an indicator that flashed a buy signal that's quite rare. Since 1945, the Zweig breadth thrust indicator flashed a buy signal. It's only had 18 of those since 1945. 100% of the time when those happen, the market has been up a year later, and the average increase is a little over 23%. So I've talked about that before, but it's still pretty important to understand. And then as of yesterday, November's move for the S&P 500 was up 8.9%. And when that happens, again, in this case, since 1950, the stock market is also averaging a 14.9% rate of return over the next 12 months and is positive the next month. So an average of 1.8%. So that bodes well for December. So really, I've had a lot of clients asking me about, what might be happening in 2024. Still hearing a lot of news about possible recessions and those types of things, which is obviously a potential case. But if you look at the stock market and you look at the averages and you look at kind of these different things that have happened historically, it is pointing to a stock market that has a positive rate of return in 2024. So, and what happens in these really big months is you just get so much momentum, and you've kind of cleared out so many different, situations, and everybody starts to jump on board. And I thought, maybe even today, since it's a new month, we might see a little bit of sell-off. We got Chairman Powell, talking aggressively about keeping rates up and those types of things. And the market went ahead and set a new high for the year. Just shows you kind of the power. It really kind of a momentum concept is a body in motion, kind of continues in motion, and that's the idea behind this as a whole. And things are really moving. What's very fascinating is that, on the 27th of October, which is when this particular downturn hit its bottom, high for the year was the end of July, and then that 27th of October was the bottom, a little over 10% drop. We had a show at that time. That was a Friday. We presented the Bank of America, institutional survey, where they ask, the big money managers, the pension, mutual fund, hedge fund managers, a lot of different questions, but one of which is, what is your exposure to the stock market? And the answers were the lowest exposure to the stock market in the last 72 years. So what you have is these very large pools of money that can actually make a difference sitting on the sidelines right before we just had an 8.9% run up for the month of November, and actually a little over 10% run up from the bottom there on the 27th of October. So just kind of incredible. And what people are getting wrong here, at least in my opinion, I mentioned this before, but it's worth repeating, is there's two big differences that are happening here. Normally, when you raise rates as much as rates have been increased in a short period of time, you have a recession and you have a stock market that goes down more than this one has. And so the difference this time, of course, is number one, the pandemic. Haven't had one since 1918. So it's very difficult to, you look at 1970 and the inflationary situation there and try to draw parallels and try to react as if it's 1970. You're missing out the part of the pandemic with the pent-up demand that's kind of pushing things forward and consumer spending that continues to go. The second thing is that, as of 2008, we have, as a country, and maybe even now as a world, have figured out that we can kind of push money out the door to try to stimulate the economy and get things going. So in '08, the market was really falling apart. We had all kinds of problems and potential, closures of very major institutions like the car manufacturers like GM, et cetera. And so they started doing some bailouts, some stimulus programs and things, and it worked. And at least, in that time frame, and we ended up with a pretty nice stock market run. Then we had 2020 pandemic, everything's closed down, did the same thing. Federal Reserve did the same thing they did in 2008, which is start buying bonds on the open market. They hadn't done that before. It's called quantitative easing. This is a new concept. They did that again, in 2020, and actually purchased $6 trillion worth of bonds. And so go to this year and you look at what happened with Silicon Valley Bank and Signature Bank, First Republic Bank. And what was happening is really an implosion of the, regional banking system potentially, because of the bonds coming down so much. So banks have to have a certain amount of capital on hand. And essentially what happens is if your bond that you purchased, let's say new for $1,000, will come due that $1,000 payout and you make the interest in between time. But if the bond market falls in between times, you might have a $700 bond. And the problem for the banks is that now they've got this big hole in their capital and they have to fill that. So Silicon Valley Bank went out to fill that by, trying to do a secondary stock offering, and it really backfired, and they were put out of business, unfortunately, because people were afraid what that meant. So the government stood up and they said, okay, we're going to, backstop those depositors that have more than 250,000, and we're going to put together this special institution where you can give us that $1,000 bond. We will give you $1,000, and we'll hold it until it comes due and take the $1,000 back. And that was very popular and really shored up the capital problems that these banks were having. So this is something that is fairly new where they're figuring out, and this is both parties have done this. This isn't a one party thing or what have you, but this is just a concept that you would want to do potentially to stay in power because, they let Lehman Brothers fail in 2008 and we had a regime change. We went from a Republican White House to a Democrat White House, for example. So nobody wants to do that anymore. So that's the two differences, the pandemic, pent-up demand, and the fact that the government isn't letting things break like they did with Lehman Brothers. So I think if Silicon Valley Bank is allowed to just close up and all those regional banks are just allowed to close up, we're talking about another situation like 2008, markets probably down, 40, 50% from its high instead of 28% in the end, which is what happened so far. Now, something could still break. They could break in an area that the government can't control. Could be China, could be something else. Still something to watch for because when rates come up this much, you kind of get to see, Alan Greenspan talked about this one time. He said that, basically get to, when the tide goes out, in this case with the rates coming up, you get to see who's swimming naked. And that's one of the, problems with this type of rate increase. So can't say that we're completely out of the woods. We'll have to see how this plays out, but earnings are doing well. Job market's doing pretty decently. You've got a situation where, the gross domestic product was revised up to 5.2% for the third quarter, which is ridiculously high. I still say that the biggest risk isn't recession. It is actually just, reigniting of the inflation. Because things are pretty, I think, fairly warm, if not hot in the economy. There are certain segments. We saw that the factory report that came out just recently showing some softness in factories. That's been going on for quite a while. We all bought goods in 2020 and kind of filled up our cupboards with all the things we wanted to buy. And then once we could go out and do services, we're not buying the goods anymore. We're going to restaurants, we're going to travel, we're doing these other things. So services, again, were pinched really heavily by the lack of labor. People weren't coming back into the labor force. That has gotten a lot better. So I think what you have now is maybe the supply is starting to kind of catch up with some of the demand. And that's why we're continuing to see, inflation, come down. The report for the PCE core inflation, which is the measure that the Fed looks at that just came out, yesterday, was quite good actually. It's a continuation. We're down to 3.46% on PCE core. Again, they're looking at 2%, so not bad at all actually. So things are doing really well. It's been very exciting to watch this. Now you got to keep in mind, unfortunately, that this giant run that we just had in November really is just a recovery of the money that we lost in August, September, and October. But we'll take it. We are at a new high for the year. It took a few months to get there because we were there again, at the end of July. But it's nice to see. Hopefully, this kind of continues. Again, we end up with a lot of kind of weird things that happen at the very end of the year. So be prepared for that. Last couple of weeks could be volatile, if not down. Lots of rebalancing things happen. People are taking tax losses and all kinds of things happen. Might want to wait through that volatility and try not to overreact to it one way or another, and then wait and see what happens in January. Because if we look at last year, we had a pretty good sized drop in the last couple of weeks. And then January was actually phenomenal. And we brought that right back. And February continued to run for a while too. So not a bad time frame to be invested right now. Really look forward to seeing what's going to happen next week. And we'll be out there, doing our videos and taking care of, business. Again, we'll be doing the show again next week also. So look forward to seeing you then. So thank you very much and enjoy your weekend.